And as always, we're going to be looking for accurate context, good risk management, and always exercising good patience.
Everybody who's traded has gone through periods of time where their strategy hasn't worked.
Where if not a hard stop, you should reevaluate the trades you're in based on time.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
Hello, everybody. Welcome to Coach's Playbook. I got a big thing of coffee and a White Castle mug. It's the little things you need to deal with a day like today, which, oh my goodness, what a day. In case you guys didn't know, the CPI number came out this morning and it was a bit hot, as we have said in the title of this video. So we're going to go into that and the big move that happened off of it. But first, Mick, I understand you have a series of shout outs for us today.
Yeah, series of shout outs, mostly to those that were playing the short side in the equities earlier this morning.
Really?
Yeah. So instead of just listing one, we've got a lot of people that are up some pretty serious dough today. So shout out to Gideon Gordon up 10,700. Kunhan Chang up 5,200. Anthony Stevens 4,400. Chu-Yan Chu, 4,000, Pete Oslowski, 3,700. I could keep going, but those are the big P&Ls we've seen today. So really exciting stuff.
Some big days there.
Yeah, that was pretty funny about mostly from playing the short side in equities, because we had a nice fat 120 point candle to begin after the CPI number, which came out at plus 0.1 month over month. And 8.3 year over year. Everybody and their mothers, grandmothers, great grandmothers was expecting a month over month decrease into this number. And that's why you saw it crash so much. Hogue, you were on the forecast this morning. Could you give us a little of your thoughts on kind of what was in this number and what's happening here?
Well, for the last couple of days in the forecast, I've been saying, the equities like to rally, and if there's no bad news, they like to rally. And I'm expecting this rally to continue until the moment we have some bad news. And we got that bad news today in those CPI numbers. Don't forget, we have PPI tomorrow as well. So we found our bad news and we got our pullback. I don't know if everybody noticed, but there was a 12-point gap in the S&Ps on the way down where there was not one trade. It was offered all the way down. So if you had a stop in there, you really experienced a little bit of slippage in that. And nobody of course wants that, but these things do happen. Pretty important number today. And so it's seriously changed the context of the market. We're always trying to figure out accurate context, look for good hypotheses. When that number came out today, I had all this good stuff written down for the forecast, for all these markets that were all written before the number came out. So I had to readjust everything and change my context of the market because, again, we were looking at that market just kind of rolling higher, and that's what it does until you get some bad news, and then wham.
Yeah, wham indeed. Something that's interesting about all this, we discussed that last week, what Hogue said about the gap. So you don't want to be trying to, if you're going to trade through these numbers, you can't have the stop on. Actually, before I go into my spiel, Dan, what are your feelings about all this?
Well, Jack, I was kind of going to touch on that. John made a good point here, talking about a 12-point gap. Obviously, if you're stuck in a position, you're on the wrong side of it and you can't get out. These are the times that we talked about last week. And I think we've historically talked about a million times over the years, being able to be trading at a point where you can easily get in and easily get out at prices you want. I saw traders today get caught in slippage. I saw them, because of that slippage, lose an extra $1,000 more than they wanted to lose. I mean, I saw a lot of that happen today, and you have to think about it, right? Like these numbers come out. Yes, there's great opportunity, no doubt about it. But staying out for a minute or two or 3 minutes or 5 minutes, look at what NASDAQ is doing. Down over 4%. That number came out. We were down 1.5%, 2%, give or take. So there's still twice the amount of move to go. And you could have sat on your hands, not put yourself in a risky spot, waited for things to get a little bit more stable, a little bit thicker, and taken those moves to the downside. So I did want to touch on that. But in regards to the number, right, like month over month, a little bit of a shock, maybe for some people. As I've sat here, you know, I look at my everyday expenses year over year. You guys have all heard me preach about my filling my truck with gas
prices.
I mean, yes, maybe
boats.
Danny
maybe
Gas.
filling the truck has gone down a little bit in the last 6 months, 3 months or so. But I don't know. I filled up the other day. It was still pretty damn expensive. I live across the street from a gas station here in Wisconsin, which are relatively low gas prices. $4.29 this morning, looking out my window. So that's, you know, still pretty darn high as a cost per gallon. Major costs are super up. You can go to the grocery store where I used to buy chicken. You know, the chicken used to be, I buy a 3-pack of chicken thighs and it was like $27. That's up about 35% year over year on my own expenses when I look at my budgeting. So like some of this stuff really has drastically changed. If you go to the meat market, right, and you're looking to buy a steak, I'm not seeing the cost per pound of ribeye come down. I'm only seeing it continually, steadily going up on a daily basis when I go in and look at this stuff. So truthfully, I'm surprised it's as low as it was. I expected higher numbers personally. I know, Jack, we have a lot to talk about next week on the podcast.
Right. I mean, year over year, you're right, Dan. It's what's a little bit, the Fed, they're kind of being hard asses right now, because it's important to look at the month over month print and the year over year. The year over year is high, 8.3%. The month over month at 0.1, you know, annualized, that's like 1.2% inflation per year. It's not much. And I think they're walking a difficult line where they don't want this sort of asset euphoria that was happening coming out of the pandemic if they act too dovish. But they're going to raise another at least 0.75 at this next meeting, right? But what's going for
get those mortgages now.
Yeah, get the mortgages now. But like going for the disinflation, right? Like year over year, it's bad. You have to be very careful about starting to have a bunch of negative. I mean, we all want the prices to come down, but like you can really do some damage to the labor market if you're trying to too rapidly do it. I would think that, you know, if I'm at the Fed and I see that 0.1, that's pretty good. We want to see it going down. Remember, year over year, that's going to, if it stays where it is, it's going to come down quite a bit because we'll start getting to the part of last year where we started getting inflation. That'll come down. But bringing prices down is kind of tricky, but just a thought there. Mick, anything else you want to add to that?
Yeah, well, I would say as far as bringing the prices of things down, I mean, I would highly encourage everybody to read the CPI report, and it gives you a breakdown. You know, there's different sectors or categories of this, you know, energy being one thing. Gasoline, the gasoline index was down. You know, we've seen the sell off in the crude oil, which is a byproduct of gasoline. So, I mean, that was pretty much the only thing in this report that was down. Everything else was up, you know, vehicles, transportation, food, housing, all that kind of stuff, you know. So if you can get some things like transportation down, you know, that would trickle into, you know, the price of food and other, you know, hard tangible goods. I want to touch on some things that all you guys have talked about. We got Danny Gasoline over here. You know, I'm waiting for those prices to continue to go down. It's nice to see that. I've got an 81 gallon tank in my boat that's empty right now that I'm not looking forward to filling
and
up.
they will go down from this number. This next Fed move is a gasoline move. It's not good for stocks, but I think that's going to continue that trend.
I've been holding off because I have seen, where prices were $6 or more, at least in Wisconsin, they're down into the mid threes, which is really nice to see. Danny in Milwaukee, a little bit more expensive. Meat, I always liked buying tenderloins from Costco. I've gone from doing tenderloins to skirt steaks now. I actually am finding out that that's quite tastier. But Hogue or Jack, you started off talking about the 120 point bar in the S&Ps. 100 of that 120 points was on a 1 minute bar. I broke it down to a 1 minute bar, and we had 100 point range in the S&Ps. So no surprise there that, John mentioned there were 12 points where no trading occurred whatsoever. This is just, I don't have much else to say. These things are scary. And with a release like this, CPI, up until, over time, certain releases like GDP and other things, unemployment and stuff, those mean more in certain environments. And this environment that we have right now, the CPI has been, the real driver of the market when it comes out. So read up on that, learn about these things, always be aware of these releases that are coming out. We don't require you to be flat for these economic releases anymore, but gosh, it would not have been fun to have been long even one S&P contract without a stop on today, and you get up to go get your coffee and you come back and you're out $5,000 on a one
even
lot.
With a stop, your stop
1 minute later. Yeah, I mean, there's no guarantee, with the stops. You're guaranteed that it gets triggered and you get filled at the best possible price, but that could have been, many points away. 12 points is about $550 in the S&Ps if you had a stop on.
And that's only if you have a stop market. If you have a stop limit, how many stop limits got run through and left behind on that move to the downside today?
Absolutely. And that's why we say don't use stop limits. You need to use the stop markets.
How many guys were trying to drag it or click it in as opposed to maybe clicking a cancel all? Some platforms finding that little button. I know some of the platforms I've traded on in the past, it's hard to find it. So you're trying to catch it. And as it just keeps moving, you're missing in the queue. And it's moving past you. You're like, shit, I missed that one. I missed that one. I missed that one.
You need a computer monitor flipped vertically the size of a tree to see what was going on.
Have you guys all seen the Good, the Bad, the Ugly?
Yeah, long time ago.
Okay, so when the guy
outlawed Josie Wales.
Right. So when the guy comes in to shoot the ugly in the bathtub, right? He's telling this whole story of like why he's going to shoot him and stuff like that. And the guy just shoots him from the bathtub and says, if you're going to shoot, don't talk. That's how I feel about the stop limit orders versus stop market orders, right? If you're going to puke, don't just put it in the market, sit around, right?
Yeah.
Hogue, I want to throw it over to you really quick. It shows kind of how, speculative these markets are right now, right? Like this was a hot, by the way, we're saying hot. It was a 0.1 month over month. And I think the whispers, like people were maybe expecting like minus 0.2, minus 0.3 or something. But like, call me crazy. I feel like if it was zero, so like 1/10 of a point less, we would have, I don't know, maybe seen half the move or something. It's wild.
Yeah, I could see that. I mean, we were pretty outstretched to the upside. So there was much more risk to the downside than anything that could have happened to the upside. So much more risk to the downside. So even if the numbers came out as they were supposed to, we probably would have had a break today.
Yeah, I think that's why it's important. Like we mentioned, the whisper numbers, on any number, know the estimate and know the whispers, the rumors, sort of master of whispers, Game of Thrones style. Need to have your ear to the ground, so to speak. Sorry, Mick, I cut you off. Is there something else you wanted to throw in there?
No, I'm fine. Thank you, Jack. Appreciate you following back up.
Yeah. Well, guys, going forward now, let me take a look at the handy dandy chart because who knows? Okay, so we're at 4,000 in the ES, pretty much on the head within a few points. Those big, fat, round numbers, as we say in our nice language, can be sticky. So it'll be really interesting to see in the next couple of days if the buyers or sellers take control from there. I have doubts that the buyers will take control until I feel like we're going to be stuck around here until the Fed meeting, right? I mean, I don't think they'll raise 1%, Hogue.
I don't know. I mean, there's been a lot of rumor of that because the sore from today is very fresh. It's a very fresh wound. So a lot of people are thinking that, of course, may happen. Now things settle down between now and Fed Day. Of course, that's going to keep everybody more tired towards the 75 basis point idea. But we have a lot more data coming out this week. We got PPI tomorrow. We have jobless claims, Philly Fed. There's a lot coming out on Thursday, and then quadruple witching. Don't forget it's rollover this week, which makes the equities markets a little bit crazier than normal. Sometimes they don't go far enough. Sometimes they go too far. You've got all of the longer time frame traders more concerned about getting the rollover done cheaply than anything directional. So the fact that this happened now I think it's exacerbated the move to the downside. I don't think we're going to be moving, tremendously either direction until after the FOMC meeting. And that's, a full 100 points either direction from where we are now.
Jack is muted.
I try to be responsible while I'm not talking. I get caught sometimes. 2-year treasury yields up to 3.76%. That's starting to look kind of attractive. You don't pay any federal income taxes on the yield from that. Never thought I would see that.
That's a huge number.
It's a big old number. But that kind of shows the reason is because the Fed is talking so aggressively about hiking short-term rates for the foreseeable future. That's why the 2 years so much. And let's take a look at the 230s. What's the 30-year yield right now?
The 30 year is 3.51.
Okay, so that's interesting, right? So right now you can get 30 years at 3.51 or 2 years at a better yield. That's inverted. That's
get a 1 year at 3.7.
I'm gonna go take all my cash and put it in there.
Right.
So
that's kind of what I'm thinking.
Yeah, except I don't have any cash because I'm buying a house. Huh. Dilemmas, trade-offs.
Those mortgage rates. At least you got it before the next hike, Jack.
Yes. So we'll keep an eye on that.
The 10 years, the weakest one, you're only getting 3.35,
which is still up.
Well,
for sure.
As a yield curve guy, I could explain to those of you out there who maybe aren't. It makes complete sense if you think about it. We kind of got this like I gotta go up to the camera, like a U-shaped curve. It's because of all the short-term rate hikes. They think that. So it's like from beyond the short end, it's acting normally. Like the 10-year rate should be lower than the 30-year rate because you're taking more risk duration. But right now, it's just the short rates that are all jacked up because the Fed is being real aggressive, let's say. So hopefully that works out for everyone.
Hawkish is the term.
Hawkish, indeed. So, man, it'll be if they get a little bit less hawkish, it'll be a real bonanza. So fingers crossed. Eventually. All right. Anyone got any final thoughts before we throw it over to the quote master?
I think at the end of the day, just be cautious. There is a lot of information coming out there right now. I think this is a time you got to thin up your contracts, maybe downsize a little bit, maybe consider looking at the micros if you're trading one lots maybe, and that's taking a lot of heat. Like think about the micros. At the end of the day, it's all about continuing to trade. It's not about catching that short-term move. Obviously, there's some opportunity, right? When we do see these big moves, everyone wants to be involved. And it's really fun if you're on the right side, and it really is painful if you're on the wrong side. And you don't want to be on the wrong side and have that kind of be the end of that trading career for you. You want to be able to be here, a month, 6 months, 6 years, a decade down the road and say, I'm glad I downsized when all this volatility came through and wild things were happening during these big numbers. I was able to downsize and I was able to continue to keep trading.
Well put, Dan. And do you have a quote for us today, or is that your quote? It was just Dan Hodgman. And then okay.
Now, I thought about bringing back Anonymous for the 4th week in a row, but I got one from our very own Jerome Powell. This goes back to about 2020. If inflation were to move up in ways that were unwelcome, kind of like right now, we have tools for that, and we will use them. No one should doubt that.
Good thought there, Dan. I thought you were going to be money gun goes burr, Jerome Powell, circa 2020. Yeah, that's all I got. Hogue, do you want to take us home?
Oh yeah, sure. In direct context with what happened today. It reminds me of my dear old dad who used to tell me, get out when you can, not when you have to.
Applies to all
Good advice.
situations. So thanks for watching, everyone. We'll be back next week with a new episode. Hopefully a better market day that day. We'll see. But until then, have a great day, trade safe, and we'll see you later.
Blessings, everyone.